Welcome to the Artisan Podcast, where we share insights from the investment world's leading minds. Today, you're in for a real treat. We have Noah Ramos, Alpine Macro's Chief Innovation Guru. Now, Noah is an expert in all things tech, but what really sets him apart is his ability to take complex and rapidly changing technologies and explain what they mean for the economy and markets to simpletons like me. Enjoy. So without further ado, Noah, Micron's up 700% over the last year. Lumentum, the former JDS Uniphase, which I used to own, is up 13 times over the same period. The Kospi's doubled this year alone. AI has now hit the cover of Time magazine as of last March 26. So far we're not getting tips from shoe shine boys, but who gets their shoes shined these days? So tell us, when is the bubble going to pop?
Yeah, that's $1 trillion question on many fronts. Our house view at Alpine and my personal view is that, we have not entered overcapacity territory yet. And I'm going to explain that for a few key reasons. So, one, historically speaking, some of these mega tech companies have traditionally been some of the best stewards of invested capital. However, I think the key question for investors here is separating magnitude versus duration. So, in terms of magnitude of this cycle, the intensity of it from a CapEx perspective, we are at comparable levels from our analysis to being at the telecom, magnitude. However, in terms of duration, we think we're much earlier and we're not at the peak yet. So we think, roughly speaking, to use a baseball analogy, we might be, transitioning out of the, second half of the fourth inning into the fifth or something like that. Our conviction is grounded in that there's so much visibility in demand. That can be applied to silicon, that can be applied to electricity infrastructure, to generation. And the key for us in terms of, the duration call is that our view is that, AI and the AI trade holistically is shifting from something that was more cyclical, whether that be silicon based, to something that's more structural. As AI becomes itself, a critical infrastructure component to the economy and the growth story holistically. To get a little bit more granular there, we get a lot of questions on, aren't we building too much compute? Is there too much CapEx happening? But the fact of the matter is that, not all data centers are created equal. And what I mean by that is, there's roughly 12,000 data centers operating globally. 80% of those are not touching AI. Those are just things running, Amazon Web Services, Google Cloud. So the remaining 20 is AI. However, of that remaining 20, only about 5%, so less than about 2% of total AI capacity right now has the infrastructure capable of accommodating these next generation chips. These are your Blackwell systems. So from that perspective alone, we think compute remains extremely constrained, and we have very high conviction in that. Frontier labs, whether that be OpenAI or Anthropic, they're still both have less than 2 gigawatts of compute each. They want to be at 30x those levels in just the next 4 years. The cloud revenue backlog for some of these companies, Google's cloud revenue year over year increasing, 60+%. They have a backlog doubling to nearly 460 quarter over quarter $billion of cloud business. So we have a lot of visibility into monetization. And the last point, which is why we don't think we're in a bubble, is utilization rate. And I think that's critical between telecom specifically and where we are now. What defined telecom was this dark fiber story. There was going to be so much of an infrastructure demand, so much fiber optic cable was laid. However, the utilization rate of that underlying infrastructure was very low. The exact inverse is happening with data centers. Utilization rates of these server racks are pushing 80+%. The binding constraint for them is not that they don't have outlying demand to be at 100% or virtual utilization. It's that there's other bottlenecks, whether that be networking, data transfer speeds, throughput, and latency that are inhibiting that. So, we believe that we're still in the growth period of this cycle, nowhere near the peak, and compute remains extremely constrained.
Okay. So, I mean, for anyone who's been through a cycle, financial markets lead fundamentals. So if you look at the shift, for past bubbles, or if you look at even a bull market, it starts when everyone is so negative that the reality just can't turn out that bad, and then you get a correction, and then you see the fundamentals improve, and then you get a correction, and then the last phase is an overshoot. And tech is no different. I mean, the relative bull market started in 2007. Nobody was bullish on tech back then. So, I mean, what kind of indicators should we use, to get out? Because with all due respect, you are seeing a lot of these classic indicators. I mean, when something is on the cover of Time, which is not a financial publication, but it's a specialty publication, who are you going to sell to? Who's not involved? So, I mean, what indicators would you use? I mean, you're saying, look, we're maybe halfway through this. So how do we know when we're in the 8th inning? Not fundamental, but financial.
Yeah, so for us, one of those is, the diminishing returns on invested capital for hyperscalers, first and foremost. Right now, we're not seeing any compression in that. If you take the capital outlay of, one of these hyperscale companies, and you take their realized profit and you divide that by their capital outlays, you're getting an expected return still north of 15, in that 18 to 20% range. And that it's staying there despite capex continuing to be guided upward. There's a lot of concern about this free cash flow decline story, that compute is now scaling so quickly that the free cash flow levels of these companies is plateauing. I think there's critical aspects of the compute stack itself that are going to drive margin expansion. Primarily, that's the reduction of the cost of producing tokens for hyperscalers, also the scaling of context windows and such things. But for us, and for me, the sort of like what would sound the alarm bell. One is if that diminishing return number begins to decrease. Two is if, Mark Zuckerberg or one of these big tech leaders comes forward in earnings and guides capex downwards, whether that be the next quarter or forward. And then the last, two risks, which are more related to AI's functionality specifically, is, what is AI's ultimate ability to deliver on AGI, or is AI going to continuously improve? One aspect of that's beginning to concern me more and more, that I think investors need to consider, is this sort of compute allocation dilemma, which I've been discussing. And it's really that a hyperscaler or a frontier lab has almost this dual mandate, similar to the Fed, right? They have to have enough compute to train models and to release new models, but they also need to have enough compute to satisfy their inference demand, which is ultimately how they make money. So their ability to do that and wear both hats, because they're so compute constrained right now, is a bit of a juggling act and a challenge. And if you start getting to the point where the race to release new models begins to degrade the output, meaning the inference capability, that could result in a decline in AI demand or AI TAM. So from a financials perspective, it's capex guidance, and then also that return on invested capital. And more from a tech AI perspective is like, are we going to continue to see these model improvements at this level? And also, how good is the intelligence in terms of its scalability to satisfy overall demand, given the constraints?
Yeah, I mean, we'll certainly get into fundamentals. I mean, for me, what I've, as our listeners would know, what I've used to time all the previous bear markets and ending of a bubble is a problem in credit. I mean, so if you look at the 1990s, pets.com goes bankrupt, that's a problem for a couple cats and dogs. It's an equity loss, but it's when the telecoms had issues. So I think you'll see it in risky credits first. You've kind of seen that 3 to 6 months before all the major tops, to be honest. And I don't see this as being different. So, you make a good point in terms of, speaking about fundamental improvement. I mean, it's just astonishing, some of the numbers that you've put out in your report. The improvement in either speed or compute per unit X is just so much better than Moore's law was for traditional semiconductors. Maybe you can explain why that has occurred or how that has occurred, and whether you would expect that to continue or to diminish, or maybe it still stays. It's not as fast as it was, but it stays faster than Moore's law. So kind of tell us where we've been and where we're going to go.
Yeah, so we've Moore's law, in my view, is completely dead, right? So the idea that you double transistors every 2 years, that's analog now. We're in to have a comparison like that. So conceptually speaking, NVIDIA's H100 or Hopper system, we've seen about 1,000x leap in compute for that in just about 4 to 6 years. So where we are from Hopper to Rubin, which is going to be, your Rubin rack is your cutting edge Ferrari rack from NVIDIA. Rubin on a per chip base is going to give you about 50 flops of compute. 50,000 flops of compute. Your H100 gave you about 4,000 flops of compute. And this is a result of innovation primarily on the packaging of how semiconductors, this chip on substrate on wafer, also EUV being able to go down from 7 nanometer, 5 nanometer, now we're at the 3 nanometer level, being able to increase transistor density just on substrates. If you look at the scaling of flops of compute on a per chip level, we're still sort of on this exponential trend line. Every subsequent chip generation from NVIDIA is climbing that wall scale slightly at a smaller step, if you will. However, where you're getting larger increases in compute, but you're also getting radical improvements in energy efficiency per calculation, and radical improvements in how cheap it is to produce the intelligence, which for AI is what your cost per token is, which is ultimately what matters for these hyperscalers. So, this is why, in our view as well at Alpine, is like we remain very constructive on next generation silicon. Is although upfront you're paying a premium for, its ability to reduce your operating costs as AI scales is really where the sweet spot is for this infrastructure build out.
Maybe we can use that as a foray to kind of talk about a build out of an individual data center. From here, you spoke about a lot of the ones in the past not being useful for AI for various reasons. So maybe you can kind of speak to the economics of building a data center, the cost of construction, potential revenue that could generate, and beyond the construction, kind of the cost of the GPUs and various other tech equipment and what's going on there.
Yeah, for sure. So I think critically it's really what silicon is going into that data center. That's the largest variable cost. So, overall, if you smooth this out, about 50 to 60% of your total CapEx for a data center is just in silicon. Now that's going to be balanced between your GPUs, so your NVIDIA units, your CPUs, so your Intel, your old school CPUs, and then also your memory, so your Microns, your SK Hynixes, sort of that three blend. The majority of chips actually now is your CPU, because every GPU needs multiple CPUs to coordinate data, as well as every GPU needs multiple memory chips now in order to be able to offload the memory demand from AI. So there's more memory and supporting chips than just GPUs. Key distinction. The second point, in terms of primary cost, is going to be your electrical infrastructure, your grid generators, your grid tie. That's going to be about another 20% in there. You're going to shift on to the third largest, which is your cooling cost. This is evolving from traditional HVAC, which is really the reason old data centers can't be repurposed for AI. AI-specific data centers need this liquid cooling technology. That can be done by either immersing the entire server rack, so the rack where all the chips are housed, into an electrolyte solution, or the best way to do it, which is what the cutting edge data centers are doing, which is direct to chip cooling. So that's bringing cooling to the actual chip level itself, which reduces the downtime of the system and increases the longevity of chips. And then only about 10% of the cost of a data center is actually the four walls, the physical building, etc. So you can see that it's vastly skewed towards silicon. So as an investor, what does that mean? Okay, I'm thinking about depreciation cycles first off, right? So how quickly are these chips going to be able to be useful for? And are they going to have to be replaced every 3 years? It's going to be 8 years. What is that going to be? Because the OpEx of the data center is really going to be heavily contingent upon that. Our view and what essentially data has shown is that NVIDIA might say that their GPU can only function properly for about 3 years. However, software innovation and the supporting infrastructure of these data centers itself now, that specifically that cooling, is extending the chip longevity now much faster than it did before. So there are Google TPUs, there are Amazon chips, there are early NVIDIA chips that are 3 to 7 years old that are still running at 80+% useful life. So our view on depreciation is that there's going to be less so, whole cycle depreciation. So we're not going to phase out entire chip generations. What's going to happen is that the compute stack is going to be diversified to satisfy the specific demand. So what I mean by that is a certain customer for AI might prioritize ultra low latency. So they want very quick response time. And there's certain silicon, for example, chips that are inference prioritized. So these are not GPUs. These are your TPUs, your ASICs that are very good at delivering on that. However, someone might want very big parallel processing that's GPU based, for example. So the silicon stack is going to become more and more diverse and allow for this outcome-based pricing, which will allow, from a monetization and data center economic perspective, allow hyperscalers or frontier labs to be able to capture more revenue from shifting away from just a subscription-based model to more of this outcome-based pricing based off tiered silicon and being able to satisfy specific parts of demand from specific chips, if that makes sense.
Yeah, it does. But essentially, the faster the innovation, the longer the life of the semiconductors. That seems counterintuitive.
The supporting infrastructure behind the semiconductors is improving and extending the valuable life, extending how useful they can be plugged into that infrastructure. Now, they might not be the quickest and most fastest chip compared to the next generation, but they still will have useful applications because the applications for AI itself are also diversifying, and the demand for AI is diversifying simultaneously.
Yeah, I mean, if you look at telecom, nothing ever gets thrown away. We're still using analog from 40 years ago, but the return on that or the value of that is much different than it was 40 years ago because of the underlying innovation. So maybe we can use that as kind of a foray into this shift to inference. It seems to me like as opposed to building a model, inference will more clearly be economic and provide a return. Because when you're building a model, you're doing something that could deliver future revenue and could deliver future profits, but it's an investment for the future. Whereas inference, like you're putting in money or whatever, or using your past capital spending and you're getting your return, right away. So maybe you can speak about this shift to inference, what it means for the economics, what it means in terms of some of the things that you spoke about, of the different things that will need to be purchased for inference as opposed to building the model. What does this shift mean?
100%. And I think it's really critical. I think we're at the threshold now where we're going to start to see the monetization level of this begin. We're going to start to get more clarity on that. For example, your output token. So when you input tokens to an AI system, so what I'm loading into there, for a million tokens, that's about $5. However, when a lab processes that and gives you an output per million tokens, that's about $25. So your output tokens are about 5 times, going about 5 times the rate as your input. So that's where your monetization is coming from. The key for hardware is, which I alluded to earlier, is that the silicon that is best at satisfying inference is very different than the silicon that satisfies training. So you really need GPUs for training, but you really don't need NVIDIA Rubin chips, which are GPUs, to have cutting edge inference. Now, there's a lot of nuances throughout all this because you can buy an NVIDIA Rubin server rack that also has an NVIDIA based inference accelerator on it. So you can't make apples, everything's apples to oranges, if you will. However, overall, the shift to inference is bullish for more custom semiconductors, less reliance on GPUs. If you look at where CapEx intensity is earmarked for, specifically after 2027, over 50% of that is towards inference infrastructure specifically. Historically, over 70% was for training infrastructure specifically. And then lastly, which is really important on like the money-making aspect for hyperscalers or frontier labs, is this cost per token. Your H100 system, so that NVIDIA Hopper, that's essentially the chip that every single model that has been released today has been trained off of. That cost hyperscalers about $4.12 per million tokens. Your Blackwell system, which is what's currently being weaved in, which actually hasn't been turned on yet, that's about 12 cents per million tokens. Your Rubin system is going to deliver about 1.2 cents per million tokens. So you're getting this great margin expansion tailwind in cost reduction for intelligence production, aka token production for hyperscalers. Right. And you're simultaneously getting, which is being piggybacked off of more and more compute availability, what's called the context window, right? So that's the maximum amount that I could import into an AI system. So the maximum amount of tokens that I can paste in there for simplifying things. Now, that's where you really scale your revenue on both sides. One, it's cheaper to produce the intelligence. And two, I can import and use and output more and more tokens. So for example, ChatGPT-3, what really kicked this whole craze off, you're talking about 2,000 tokens per context window. Now we're talking 1 million plus tokens per context window. So, frontier labs, hyperscalers, it's cheaper to make the tokens and they're able to process more tokens at the same time. So that's why I think that, the economics and the free cash flow are going to become more favorable to companies that have the specific stack to satisfy inference, although that doesn't have to be GPUs. A great anecdotal point of evidence is Anthropic's, meteoric rise recently, specifically because of enterprise AI. They actually have very little NVIDIA hardware. They're using Google chips and Amazon chips. OpenAI has about 83% more NVIDIA hardware. So that shows us that, you can still have very high level compute and still satisfy demand, not just traditionally based off GPUs. So that's, I guess, what I would add to that.
Makes sense. Makes a lot of sense. So, kind of bigger picture, like what should investors be doing, right now to make money? So you're speaking about the shift to inference. Like, what would be the different sectors or companies, public or private, that would benefit from that change? And then bigger picture, what we've seen historically is, if we look at a tech cycle, it begins with semiconductors, because if you don't have the power, you can't do anything else. The rest is useless. And then you have this traditional tech cycle where massively reduced cost make many more things economic. And then you need to build out the infrastructure to make those semiconductors useful to users, and that's both software and hardware. And it's a little bit more mushy, but then you kind of get enabling software, and we're seeing that in private companies with many with over 100 billion market caps and growing like weeds. And then throughout, but really at the end is when the end user it just gets all this value. I mean, end users got a huge amount of value off the internet, even though many of the providers went bankrupt. So, like, where do you see the best risk reward over the next year? Maybe it's still semiconductors, maybe it's these other areas. So kind of speak about that. Where should people be looking over the next year or two?
Yeah, 100%. So I think, capital has flocked to the bottleneck layers consistently throughout this story, right? So it's sort of been this whack-a-mole. First it was, the compute, then it became the power constraint, then it became, oh wait, we need a lot of memory, now we need the photonic networking, different things like that. So I think from our perspective and from a risk perspective, taking AI out of the coin sort of things, we're very constructive on electrical infrastructure, power generation, and then industrials to help build this process out. However, I think that saying electrical infrastructure is very broad, right? So we all know the constraints to the grid. Just factually speaking, the United States has 2 times more generation capacity waiting to get connected than it currently has deployed. So that tells us that in the short to intermediate term, the bottleneck for AI power specifically is likely interconnection and not generation. Longer term, however, we're still very constructive on generation. But I think even diving into that deeper, we all know the transformer story. We all know we need more substations, more cables, but there's a difference between a power grid delivery system and then these last mile delivery systems for data centers. So, these are things like solid state transformers, things that take alternating current and step it up to direct current that's ready for a data center with far fewer steps. So if you dig into the constraint, there's bottlenecks of the bottlenecks, if that makes sense. So I think that's where you have to be looking now. Another area aside from, power constraints alone is durability on memory demand. Obviously, this is kind of $1 million question now as well, given how much these stocks have run, the SK Hynixes of the world. But if you look, you have extreme visibility. As I mentioned, our view is that this is more evolving into something more structural than cyclical. And then if you paste that on top of the fact that, if you look at the forward PE of, Micron or SK Hynix, it's only like 5 to 8 in that range, based off expected revenue coming down the coin. So I think that, those companies are still positioned to benefit. However, if you want to take the most risk adjusted perspective for, let's say AI doesn't play out, right? You still have tremendous reason for United States for electrical generation infrastructure and for generating itself. Our view, like on the application layer, you're mentioning sort of where value accrues over time in these cycles. For right now, I think it's very hard to discern where value is going to accrue at the application layer. I think it's going to be increasingly critical to understand the underlying semiconductor allocation, if you will, that the specific companies have based off their ability to produce, lower inference costs and how big their margins are for producing intelligence. So essentially, how good is it, Anthropic versus OpenAI's once they probably go public, Anthropic at the end of this year, how good their specific stack is aligned with where demand is coming from. And then, longer term, which obviously we all know the story of Lumentum now, et cetera, but the networking layer, in terms of what's been built out and in terms of where the demand, if you buy this whole edge AI, physical AI, distributed intelligence story, the need to be able to have data transfer speeds with sub millisecond latency is paramount.
Yeah.
Yes, the stocks have run a lot, but in terms of the manufacturing scale and the TAM, likely even more appealing than the memory market, and then also likely more shielded from some of those cyclical drivers that you see for silicon specifically, because networking can be applied to more things, just not AI. So that's kind of how we view that overall.
Yeah, I mean, uh, there's still cycles. Uh, JDS Uniphase, the which Lumentum got spun out of, could still go down 95%, but long term, which was my thesis for owning it, it's unlimited. It's kind of like storage and batteries. There's just every cycle you just need more and more and more and more. So maybe speak about that and how that could play in. We certainly have seen massive improvement in batteries for cars, and we also have the biggest increase in power generation has been, via solar, wind, or whatever. But the issue there is, you don't have you don't have the things you require in terms of power to run a data center. But if you look at, let's say, traditional power gen, you have like everything between Chicago and Texas is cogen. You can flip between different types of electricity. Do you think that there's potential for that sort of cogen for data centers? And does that really kind of lead to another layer for batteries? And what are some of the new technologies or value creation? Like, are batteries something that you're interested in? And if so, what are your thoughts there?
Yeah, well, first and foremost, I think batteries are one of the best spaces to benefit from eventual AI material innovation in itself. But that aside, you mentioned this co-location story. So, if you look at data center projects that are earmarked to get built, in 2028, 2029, more like 3-4 years down the line, the trend is having co-located electricity supply, because we're going through this cycle right now where, yeah, they're getting earmarked from, PJM's grid or something that they can tie into their nat gas plant. However, they don't, hyperscalers realize the constraints of doing that from grid infrastructure. So they want to just be able to build generation directly adjacent to their data center. So if you look at the three primary sources that co-location requests have earmarked, it's one is LNG, two is nuclear, and third is alternatives balanced with batteries. So, I think the key, sort of the impetus to the battery storage, and the reason, we're very constructive on it, is we had this period of immense battery innovation. However, it was optimized for electric vehicles. Why? Constraints on space and constraints on weight. You need a very light battery, you need a very small battery. For grid scale battery storage, you don't have those constraints. Which allows you to use much cheaper, whether that be anode or cathode materials, but also expand the size of the cell, have a bigger electrolyte, have better, recharge and discharge rate, etc. So the grid scale battery storage, I think, is a key beneficiary of AI. Not to mention that even if you have a data center that has baseload power, like an LNG plant, they're still going to want to have a backup reserve. And, things happen. And these things need to run 24/7. They're going to be, if you are aligned with my view on them being critical infrastructure, they're going to need to be supported. And lastly, for batteries, which I think is another very interesting segment aside from just grid scale, is, consumer electronics. If we're going to bring more and more computing power to electronics specifically, that compute is going to draw more and more electricity. So what we need to do is improve a few things on consumer electronics. One is how fast things can charge. If you look at, willingness to pay metrics from consumers and what they would be willing to pay for from a, for example, an iPhone, one of the top categories is faster charging rate.
Yeah.
Second is battery life.
Yeah.
And then third is, battery density. So, how much electricity can actually be stored there.
Right.
Aside from consumer electronics, there's a tremendous tailwind for drones and autonomous systems and robotics farther.
Mm.
So the battery space has all these very interesting AI correlated tailwinds. One example I love to give is there's a drone, I think it was developed by Elbit Systems, that can now remain airborne for like over 90 something days because of a
Okay.
battery breakthrough with silicon anode. And, silicon anodes have always been sort of this science fiction. We know where the value could be. However, the problem has been the cell expands very quickly. But now, because of AI and materials innovation, they've been able to mitigate that cell expansion. So I think that's just one area where you see, okay, a battery breakthrough resulting in better layers. So yeah, that's nutshell kind of on the battery side of things.
Nice. No, it sounds fascinating with a lot of different drivers. So if somebody truly can come up with a better mousetrap, then I think there's just a huge amount of value creation there. So maybe in terms of bottlenecks, we spoke about the next year or two. What do you see as the next step of bottlenecks beyond that? So let's say from 2028 to 2030 and beyond.
Yeah, I think, your most intermediate, the 2 to 3 years is your silicon, your 3 nanometer wafer production, your lithography machines, and then the grid interconnection. Longer run, it's for us, particularly for AI, is scaling baseload generation. Batteries are actually part of that because they can make renewables baseload. They can cancel that intermittency challenge.
Okay.
But one area is for us that we're constructive on is the nuclear industry holistically. This is across multiple aspects. One is the extension of serviceable reactors in the United States.
Okay.
More and more reactors every quarter are getting their life extension for approximately another 30 years. That's great for the reactor servicing market and also for having robust demand to encourage enrichment and conversion capacity for uranium to come back to the West, away from Kazakhstan and Russia. Another, longer term bottleneck, which I alluded to a little bit earlier, is this photonic networking story. I really think that it's extremely intertwined with the space economy as well. A lot of the technologies have been leveraged for satellite communications, etc., but now they're sort of at their inflection point for proliferation. And lastly is something that's a little bit more niche, and that's chip power delivery systems. So right now, when a semiconductor gets power, the power comes from the top and it percolates down through these nanometer wires all the way to the substrate. However, because we have so many chips stacked up now vertically on these dies or on these substrates, they're getting very hot and you're losing a lot of voltage as the electricity percolates down through the chip. So there's going to have to be new ways to power the individual chips specifically. One of those ways is to go through the back that needs to be rerouted throughout the entire server rack. And another area is silicon packaging itself. The substrate materials that we're using right now, they're not very well aligned to meet the thermal requirements going forward. So look for innovation there on the packaging specifically. Things like glass substrates, carbon nanotubes, things like that may prove to be larger, more niche constraints as the scale out of the infrastructure accelerates.
Well, I think, now that Google's AI is writing 75% of the code for its own models, I'm pretty sure that AI will figure out all these problems itself. So maybe we can kind of very quickly speak to, what industry gets impacted next. So software, we've seen, massive increase in profitability, down 3%. I mean, for tech overall, down 3% in terms of employment. And, certainly we've seen some traditional software firms get hit in terms of debt. So what do you see as the, next industry or two where they'll see substantial disruption, which I assume is along the lines of decreased employment, increased profitability.
Yeah, I think you're going to start to see that more so happen in finance as well, through the rise of fintech. And just to say, if we compile all the research that has been done at, where AI is best and where AI could actually, impact the most jobs,
Yeah.
it's white collar knowledge work, coding, writing, summarization, and financial analysis, and then like very basic legal work. So,
Right.
with that goes without saying, you could use it as a proxy to sort of identify what's next. But I think it's important to say, like, yes, there's going to be destruction, but there's also going to be opportunities. So, if we look at SaaS, right, like this whole SaaS apocalypse that people are talking about, SaaS that merely codifies a human workflow is at risk. But SaaS that performs a task, in my view, is less so and actually might benefit. And I think people are missing something key on SaaS is that everyone is so worried about this decoupling from headcount, the headcount SaaS model. But I think that SaaS companies are going to be aligning themselves with being able to generate revenue from AI agents. And that's going to be where they can sort of compensate. Yeah, you're losing human heads, but maybe if you shift towards outcome-based pricing and there's 300 agents now working for that one subscription, you can kind of offset your cost there and maybe even make more money than you did before, if you're able to integrate those workflows, well. So I think that, while yes, there is destruction and it will happen, and I do think there will be, layoffs. We don't think it's going to be a, narrative where AI just becomes to be this mass displacer. We think it's going to be more of a force multiplier. But I do think there's going to be pockets of value that get indiscriminately attacked from, the prevailing narrative that actually, if you peel the layers back, might have still some value there and value that can be benefit from AI as it sort of symbiotically aligns itself in the longer term.
Interesting. So all the careers that our parents had us aspire to are not the careers that we can have our children aspire to. So what advice do you have for my 6-year-old?
Well, I think it's safe to say overall that nothing that is purely cognition based or cognitive function is going to be sheltered from AI. So I think the better question is kind of discerning what fields need the physical embodiment, what fields need that durable human trust layer, and where you're going to really need like that human judgment that can't be replicated. So I'm thinking like engineering, for example, perhaps is one of them. Critical aspects of healthcare, like we all know robotics impact on healthcare possibly, and whether that be physicians, whether that be surgeons. But I think that human centric of being a nurse, being a personal family doctor, different things like that will still remain. But again, and then there's the whole skilled trades argument, which is likely, if you're being the most logical person here, you would look into these bottlenecks for what technology is going to need and the sheer scale out of infrastructure that's going to have to be built. And you would say, logically speaking, it might make more sense to go the blue collar route versus your traditional white collar labor route. But regardless, and that aside, I think that there will still be more attention and likely more value to workflows that have a human touch point from a trust perspective. Overall, AI is not trusted by society blanketly. It's very interesting though if you look at data, for example. So about 70% of Americans say that they're concerned about AI putting many people out of work, but less than a third of Americans are actually concerned about losing their specific job from work. So I think that's just an interesting sort of thought exercise to say, well, perhaps people are more worried about the idea of it happening rather than actually it happening itself. So I think that's likely what's going to happen.
Interesting. So I think on that note, we'll kind of wrap things up. Just to kind of summarize, I think for me it's been tremendously interesting and insightful, and big picture. Noah views the AI, let's use the word mania instead of bubble, as being somewhere in the fourth or fifth inning of something that is 9 innings or maybe goes into extra innings. That beneath the surface, you want to play the various bottlenecks. So over the next year or two, that continues to be, silicon, but also electrical, and over longer periods of that, things like batteries could be very interesting. And then lastly, from a sector or an employment point of view, that white collar jobs will be under greater impact than what has traditionally been viewed as blue collar jobs. But really, we need to look beneath the surface there, rather than just saying, at scale, there won't be any more lawyers. You really have to look at what they actually do. And even for software, you have to look at what it actually does, and there'll be beneficiaries there. Certainly, there's private companies that, many software companies with well over 100 billion cap that just didn't exist 5 years ago. So is there anything that I've missed, Noah?
No, I think that's great. In terms of, I guess I'll just leave, I guess, on one point in terms of labor. When AI came out first, it was very good at image recognition. It was very good at pattern recognition. So, one of the jobs that everyone thought was going to disappear was the job of a radiologist. But a radiologist's job is to, their task is to analyze images, but their job is to help patients. So that job is still very much so intact. We actually need more radiologists than ever before, because that task force multiplication, because AI is able to read the images, has gotten so much better. So I think that's a great anecdote to kind of like extrapolate on the economy more broadly and what could happen for jobs specifically.
Well, I can certainly rest more easily now about my daughter's career path. And so on that, we'll wrap it up.
Perfect. Thank you.